Imagine a company right at the cutting edge of cybersecurity, battling digital threats, often using AI at, machine speed. But what if all that innovation comes with a bit of a valuation mystery, where the market sees a discount compared to what it might really be worth? Today we're diving deep into SentinelOne Inc., ticker symbol S. This is a company that, well, it looks poised to potentially unlock significant value if it can navigate some really fierce competition and some critical internal signals we've dug into. Our mission today: to dissect SentinelOne's core business, its financial standing, its strategic position, basically give you a comprehensive framework for evaluating its long-term investment potential. And this is all as of today, September 9, 2025. And let me tell you, the source material we've got for this deep dive is pretty comprehensive. Before we dive in, just a quick note: this deep dive is brought to you by Stock Analytics AI. Please like and subscribe to our YouTube channel. For just $4.99 a month, members get priority deep dives on tickers. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access. If you just want a one-off deep dive on a specific company, just drop us a super thanks. Okay, let's unpack SentinelOne. We're kicking things off with part one: the core business and foundation. Here we'll explore their operations, the leadership team, and of course, the financials. Our first segment in part one is chapter one: business analysis. So at its heart, SentinelOne is an AI-powered cybersecurity challenger. They operate on a software as a service model, a SaaS subscription model. They sell licenses for their comprehensive platform. It's designed to protect endpoints, think laptops, servers, and also cloud workloads. Now, here's where it gets really interesting. They've recently introduced SentinelOne Flex licensing. The idea is to lower the barriers for customers to use more of their modules, right? Drive up service consumption. It seems like a pretty smart push to deepen their entrenchment within a client's IT infrastructure.
It really is. And their Singularity platform, it acts as this kind of all-in-one solution. The goal is simplifying security operations, which can get incredibly complex. Their foundational offering is endpoint security. That includes endpoint protection, or EPP, to prevent attacks. Then there's endpoint detection and response, EDR, to identify and contain breaches if they happen. And even Internet of Things, IoT security. All of this runs on a lightweight Sentinel agent. Works across Windows, Mac OS, Linux, even Kubernetes environments. And they haven't stopped there. They've expanded into cloud security with what's called a Cloud Native Application Protection Platform, or CNAPP. That's security specifically for apps built and run in the cloud. But the really exciting part, I think, is their move into data and AI solutions, especially Purple AI. This isn't just marketing fluff. It's a generative AI security assistant. Think of it automating complex tasks, threat detection, investigation, even fixing the problem, stuff that usually needs a human analyst. Its adoption has been rapid. We're talking triple-digit growth, and has an over 30% attach rate on new sales. That's strong market validation right there. It signals their move into AI-native security information and event management, SIEM, solutions, gathering security data from everywhere to find threats proactively. And they also offer managed services, Vigilance MDR, which gives clients 24/7 access to their security analysts.
Okay, so that's a pretty impressive tech stack. What does it all mean for their place in the market? SentinelOne, with a market cap around, what, $6 billion? It's a significant growing player, no doubt, but still, considerably smaller than the giants like CrowdStrike, that's about $103 billion, or Palo Alto Networks, roughly $129 billion.
Right, the scale difference is substantial.
Yeah, but they did hit a crucial milestone recently, surpassing $1 billion in annual recurring revenue, ARR. That was in Q2 2026, ending July 31st, 2025. That feels like a big deal. It signals maybe a transition to a more established enterprise-grade vendor.
Absolutely. It's a key threshold. And if we connect this to the bigger picture, SentinelOne's core value proposition is delivering autonomous AI-driven cybersecurity at machine speed. What that means is their platform can detect, prevent, and respond without needing constant human oversight. For customers, that means speed, efficiency, and crucially reducing the burden on their security operations centers, their SOCs, which are almost always understaffed. It's about automation making security more effective.
Makes sense. Now let's zoom out a bit to the industry itself. The cybersecurity market is, well, it's massive, growing at a robust compound annual growth rate, CAGR, somewhere between 9.1% and 14.4% through 2030 and possibly beyond. And this growth is fueled by several really strong long-term trends. Here's where it gets really interesting.
Hmm.
You've got the AI arms race, right? AI being used for both attacks and defense. It's escalating quickly. Then there's the rise of zero trust, this idea that you don't trust anything by default, you verify everything. Apparently, 96% of organizations are favoring this model in 2025. That's a huge shift.
It really is a fundamental change in security philosophy.
And we're also seeing supply chain and ransomware evolution, attacks getting more sophisticated, targeting whole supply chains, plus ongoing regulatory pressure.
Yeah.
Things like GDPR, big fines. That definitely drives a demand for better security.
And within that booming market, the competition is, well, intense. SentinelOne's main rivals, you mentioned them, CrowdStrike, Microsoft with Defender for Endpoint, Palo Alto Networks with Cortex XDR, and you've got others like Zscaler, Fortinet also in the mix. It's a crowded field. What's fascinating here, though, is that customer reviews often give SentinelOne high marks for service, support, and how easy it is to deploy. So maybe that customer experience focus is a key differentiator for them.
You mentioned regulations acting as a tailwind, but that raises an important question. What keeps new players out? Why isn't everyone jumping into this market?
Good question. The barriers to entry are quite formidable. First, there's the sheer technological complexity and capital intensity. You need deep expertise and, honestly, hundreds of millions in R&D just to build a competitive platform. Then, brand trust and reputation. It takes years, literally years, to build that reliability where big companies trust you with their security. There's also a critical cybersecurity talent shortage, about 4 million unfilled jobs globally. This actually makes autonomous solutions like SentinelOne's more appealing, but it also makes it hard for newcomers to build a team. And finally, high customer switching costs. Once a company deploys a security platform, integrating it everywhere, ripping it out, and replacing it is a major headache. Very disruptive, very costly. Customers tend to stick.
Okay, so given those barriers, what's SentinelOne's competitive advantage, their moat, so to speak?
They seem to have a few things going for them. Brand strength, for sure. They're recognized as a leader in the Gartner Magic Quadrant. They have that 97% customer recommendation rate. It counts for a lot. There are cost advantages inherent in their scalable software model, shown by that high 79% gross margin. And those network effect switching costs we just talked about create customer inertia. But their most touted advantage is the AI advantage. Their platform was apparently built as AI native from the very beginning back in 2013, designed specifically for autonomous response.
But this raises an important question. How durable is that AI advantage? Everyone's talking AI now.
That's the critical point, isn't it? AI is becoming, table stakes. It's expected. All the big competitors are pouring money into AI. So the real moat isn't just having AI, it's proving superior outcomes. Lower false positives, faster fixes, stopping brand new threats are better than the competition. And that requires relentless, continuous R&D just to stay ahead. It's a constant race.
All right, let's shift gears now. Moving on to Chapter 2. Management Evaluation. Leading the company is co-founder Tomer Weingarten. He's been CEO since 2013, has a background in other tech startups. The broader senior management team seems solid too, bringing experience from big names like Workday, VMware, Oracle.
Yeah, experienced team. Now, an interesting test of management came back in May 2025. On May 29th, SentinelOne had a global service disruption, an outage. To their credit, they published a detailed root cause analysis, an RCA. They were transparent, admitting to internal process gaps and a flaw in a, quote, depreciated control system. What's fascinating here is that while transparency is good, the incident itself highlights potential weaknesses. For a cybersecurity firm, managing technical debt and ensuring operational resilience is paramount. They did commit to speeding up an independent public status page and updating their incident playbooks. Positive steps, but yeah, definitely raised some questions.
Okay. Beyond that specific outage, they seem to maintain pretty standard corporate governance, communication practices, no major ethical red flags or issues with financial reporting transparency that we could find.
Right. Now, if we connect this to the bigger picture, specifically their capital allocation strategy, it's unequivocally focused on aggressive growth, often at the expense of near-term profits. You really see this in their recent M&A activity. They spent over $400 million acquiring Prompt Security for about $180 million that bolsters their generative AI security. And Observo AI for around $225 million, enhancing their AI SAM and data offerings. It's an aggressive strategy, clearly prioritizing speed to market and expanding their tech capabilities quickly.
And consistent with that growth focus, SentinelOne has never paid a dividend. No share buyback history either. In fact, their share count actually went up by about 6.45% over the past year, mostly due to stock-based compensation in those acquisitions we just mentioned, so indicating shareholder dilution.
Which brings us to a really important question. How effectively are they actually using all that capital they're deploying? SentinelOne's return on invested capital, or ROIC, is deeply negative. It's ranged from about negative 13% to almost a negative 28%. That is substantially below their weighted average cost of capital, their WACC, which is estimated around 5.96%. So think about it this way. For every dollar they invest to grow, they're currently getting a negative return relative to their cost of funding that investment. Their growth is essentially value destructive right now from a pure shareholder perspective. Now, it is improving, but it's still way below WACC. So an investment in SentinelOne today is effectively buying an option. You're betting on the future expectation that its ROIC will eventually climb above its WACC and start creating value.
That's a really crucial point. Okay, our final chapter for this part is Chapter 3, Financial Analysis. Let's recap some key metrics. Market cap, around $6.2 billion. Revenue growth, still strong, 24% year-over-year ARR growth, 22% total revenue growth in the latest quarter, Q2 2026. And a forecast. Average revenue growth of 22.5% per year over the next 5 fiscal years. That's still quite impressive. Now, profit margins. Gross margin is definitely a standout strength at 79%. Typical of scalable software, very healthy. And here's a significant milestone. Their operating margin actually turned positive at 2% in Q2 2026. That's a big step.
Very important inflection point.
Definitely. However, net margin is still unprofitable on a GAAP basis. Generally accepted accounting principles at manage 47.25%. That loss is mostly driven by non-cash expenses like stock comp and those heavy investments in sales and marketing to fuel the growth.
But what's really fascinating here is the recent turn to positive free cash flow, or FCF. After years of burning through cash, SentinelOne generated $39.83 million in positive FCF over the last 12 months. This is a fundamental de-risking event. It moves the company from being purely speculative, always needing outside funding, towards being a potentially self-sustaining enterprise. They can now fund their operations internally. That's huge.
And their balance sheet looks pretty solid too, right? Despite those historical GAAP losses, analysts are actually forecasting non-GAAP profitability this fiscal year around $0.19 per share. They're virtually debt-free. Debt-to-equity ratio is tiny, 0.01, and a strong current ratio of 1.83. Plus, they're sitting on $800.82 million in cash and equivalents, so plenty of cushion.
A very strong cash position.
And just to reiterate, no dividends paid, no plans for dividends anytime soon.
Okay, so let's talk valuation. The standard trailing 12-month PE ratio. Meaningless at negative 25x because they aren't GAAP profitable yet. However, if we connect this to the bigger picture, the price-to-sales ratio, PS, is much more relevant here. SentinelOne trades the trailing PS of about 7.0x. Now, that sounds high maybe, but it's actually a steep discount compared to peers like CrowdStrike, which is trading around 24.4x PS, Zscaler at 16.8x, Palo Alto Networks at 14.7x. This discount isn't an accident. The market sees higher risk here, smaller scale, tough competition, that negative ROIC we talked about, maybe some hangover from the recent operational issues. So an investment here is basically a bet that this discount will close as they execute and prove themselves.
So pulling it all together, what does this imply for intrinsic value? We use a discounted cash flow or DCF analysis to estimate that projecting future cash flows and discounting them back to today.
Right. And for our educational DCF model, we had to make some key assumptions based on the data. We used that consensus revenue growth figure. 22.5% for the next 5 years, then tapering down to a 3.0% perpetual growth rate, sort of like GDP growth long term. We assume their free cash flow margin expands over time to 22.5%. That's similar to mature, profitable software companies. It reflects that past profitability that they seem to be on. And for the discount rate, the WACC, we use 10.0%. That's their calculated 5.96% WACC plus roughly a 4% risk premium, just to account for the inherent risks in a high-growth tech company like this.
Okay, so based on those assumptions, our educational DCF model generated an estimated intrinsic value for SentinelOne in the range of $20 to $25 per share. All right, time for part 2, market dynamics and risk factors. Here we'll explore the market's pulse, ownership patterns, and those critical risks involved. Let's get into Chapter 4. Market sentiment.
So what does Wall Street think? Well, analysts are broadly positive. There's a buy consensus rating from 47 analysts covering the stock. The average one-year price target is $23.41. That implies potential upside of around 27% from the current share price, which is about $18.45 as we record this.
Yeah, analysts seem generally optimistic on the outlook, but what's fascinating here is the somewhat mixed media tone recently. Lots of positive coverage for hitting that $1 billion ARR mark, and raising guidance, those are strong signals. But the stock actually reacted negatively to those big acquisitions, Prompt Security and Observo AI, over $400 million combined. The market seemed worried about the cost and the potential dilution, even if the strategic logic was sound. It shows that optimism is definitely tempered by concerns about competition and the macro environment. Okay, let's look at some market indicators. Short interest. It's currently at 5.12% of the float. That's about 15 million shares shorted. Interestingly, that's slightly below the average for its peer group. Suggests no extreme bearishness, maybe a low risk of a short squeeze.
Right, not heavily shorted compared to peers.
And the price relative to its moving averages. The current price, $18.45, is above its 50-day simple moving average, $18.08 range. That's often seen as a bullish short-term signal, but it's still below its 200-day SMA, $20.26, $21.10 range, which is typically viewed as a bearish longer-term signal. So what does this all mean? This technical setup kind of suggests the market is in a show-me phase, waiting for more sustained positive momentum before really confirming a long-term uptrend. Next up, let's look at who actually owns the stock in Chapter 5. Ownership structure. SentinelOne's ownership is largely institutional. About 82% of the shares are held by professional asset managers. The top holders are the usual suspects, the Vanguard Group with 9.42%, BlackRock with 5.91%. Also, early-stage investor Insight Holdings Group is still a major holder, plus various cybersecurity ETFs.
So lots of institutional money involved. But this raises an important question. Who really believes in the long-term potential here? Specifically, the insiders. Insider holding shares held by executives and directors are very low, just 2.75%. And over the past 4 months, the transaction history is telling. There were 69 sell transactions by insiders compared to only 45 buys. That resulted in a net disposition, meaning more shares sold than bought, of 1,635,635 shares. What's particularly fascinating, or maybe concerning, here's the CEO, Tomer Weingarten's record. Over 5 years, 74 sell transactions and 0 open market purchases. Now, insider sales can happen for many personal reasons, diversification, taxes, etc. But this consistent one-sided pattern, especially from the CEO, is frankly a clear red flag. It raises questions about leadership's conviction in the long-term upside compared to outside investors.
That's a really stark contrast, isn't it? Institutions holding or buying, insiders consistently selling. And you mentioned institutional ownership is moderately concentrated. The top 10 institutional holders own a pretty substantial chunk, giving them significant influence. So what does this all mean for you, the listener? This structure presents a notable conflict, a divergence. You've got the institutional smart money holding or accumulating versus insiders consistently reducing their stake. That's something you definitely need to weigh. Okay, now let's consider the challenges and the bumps in the road with Chapter 6, risk assessment.
Yeah, let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths, we've covered these. AI-driven autonomous platform, strong revenue growth, that recent turn to positive operating margin and free cash flow, and that fortress balance sheet with over $1 billion in cash. Weaknesses, that deeply negative ROIC, value-destructive growth for now, ongoing GAAP net losses, high reliance on constantly acquiring new customers, and that operational fragility shown by the May 2025 outage. Opportunities, huge growing cybersecurity market. Expansion into cloud security and AI SIEM looks promising. Potential to gain share on the mid-market, especially with the talent shortage, making automation attractive. And strategic partnerships could open doors. Threats, intense competition, no doubt. CrowdStrike, Microsoft, Palo Alto, they're not standing still.
Yeah.
Rapid technological change means high. Continuous R&D spend is essential. Macroeconomic pressures we discussed. And some emerging geopolitical risks.
Let's drill down on those macroeconomic factors. Here's where it gets really interesting again. SentinelOne's growth really depends on landing new customers, right? That makes them pretty sensitive to things like inflation and rising interest rates. Companies react by tightening IT budgets. Sales cycles get longer. Purchasing decisions get delayed. Management themselves have acknowledged these pressures are a headwind for them.
Absolutely. It directly impacts their sales velocity and growth potential when budgets get squeezed. And this raises an important question. What about less obvious risks? You mentioned geopolitical. Well, an emerging one to keep an eye on is potential new U.S. trade policy, specifically a proposed HIRE Act. The aim is to impose a 25% tax on outsourcing payments made by U.S. companies to foreign entities. Now, if we connect this to the bigger picture, while it's aimed at discouraging outsourcing itself, it could indirectly hit SentinelOne. How? It could significantly constrain the budgets of SentinelOne's U.S. customers who use global outsourcing. Those customers might then be forced to cut back or delay spending on other things, including new software like cybersecurity platforms. It's a non-obvious sort of second-order effect, but it could be a tangible demand headwind for SentinelOne if something like the HIRE Act passes.
Wow, okay. We have covered a lot of ground. So finally, we arrive at Chapter 7, conclusion. Summing up, our deep dive reveals a pretty compelling bull case for SentinelOne. It seems built on 4 main pillars. 1, Growth at a reasonable price, you've got impressive growth forecast over 20% annually, but it's trading at a fraction of the PS multiples of its high-growth peers. A relative value argument, too, that critical profitability inflection, turning operating margin positive, turning free cash flow positive, that fundamentally de-risks the investment thesis, shows a path to sustainability. 3, technological leadership in a secular growth market. Their AI-native platform is well-regarded, positioned in a market with durable tailwinds like AI adoption and rising cyber threats. And 4, a fortress balance sheet, over $1 billion in cash, hardly any debt. That gives them financial strength for R&D, weathering storms, maybe more acquisitions.
But conversely, the bear case presents some significant risks, ones you really can't ignore. First, currently, value-destructive growth. That deeply negative return on invested capital, ROIC, is a big one. It means their current growth strategy is actually destroying shareholder value relative to the cost of that capital. They have to fix that. Second, intense competitive pressure. They are a smaller player slugging it out with better-funded giants. That's a tough neighborhood. Third, those concerning insider selling signals. The consistent one-sided stock sales by insiders, especially the CEO, really raise questions about leadership's own conviction. And fourth, macroeconomic and geopolitical headwinds, sensitivity to economic downturns, plus that potential higher act risk indirectly hitting customer budgets. These external factors matter.
And bringing it back to valuation, our educational discounted cash flow analysis, based on consensus estimates and those assumptions we outlined, yields an estimated intrinsic value for SentinelOne Inc., somewhere in the range of $20 to $25 per share.
Right. So as of today, September 9th, 2025, SentinelOne's share price is around $18.45. That's trading at a discount even to the lower end of our estimated intrinsic value range. This suggests there might be a margin of safety here for investors who are bullish on the company's future. An investment at this price is essentially a bet on their ability to navigate that tough competition, execute their growth plan, and crucially translate that top-line growth into sustainable, value-creating profitability, meaning getting that ROIC above their cost of capital. That's the potential reward. But it absolutely must be weighed carefully against those significant risks we identified, from the negative ROIC to those insider selling patterns.
So, as you consider SentinelOne's journey, maybe ponder this. In this escalating AI arms race, attackers getting smarter, defenders racing to keep up, does SentinelOne's AI-native architecture represent a true long-term structural advantage? Or is it more like a head start, a really valuable one maybe, but in a race where all the major players will inevitably catch up on the AI front, requiring just endless, massive R&D spending simply to stay competitive, let alone pull ahead? Something to think about. And remember to like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on the S&P 500 stocks we're covering, and you can always get a one-off deep dive by dropping us a super thanks.
And the necessary disclaimer. This analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.